Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's YouTube video. I've just got back from holidays and I've been enjoying a month off, swimming around in the pool, drinking Coronas, watching UFC and boxing. And to be honest with you, I got bored by the end of it. I mean, there's only so much floating in the pool and drinking alcohol you can do. And we had some great parties over the break. Lots of people at our house here in Melbourne. And yeah, really enjoyed it. But you know what? It's time to get back into it. And I love property. I'm obsessed with property, as you probably realized by now. So I wanted to do a bit of a video and give you a bit of an update on what's happening in the Melbourne property market. And really, to be honest with you, there's been nothing really happening in the Melbourne property market for the last 12 months. It's kind of been going sideways, almost a little bit down in some suburbs. Yes, there are suburbs that have done well. There are suburbs that have done a little bit better than okay, and there's suburbs that have got smashed completely in Melbourne. But really, as a market, it's just been going sideways. It's been non-eventful in a lot of ways in terms of market expectations, and I'm going to unpack that today. I'm going to go back the last 6 months from kind of July 2024 to December. I was actually waiting for the January figures to come out from CoreLogic, which they have now, so we can look back and reflect on the year and hopefully derive some meaning from what's happening in the market. But more importantly, I'm going to give you a bit of a commentary about where the market's heading and what are the opportunities in the future, what areas to focus on, which areas to avoid, like a PDD party. So sit back, welcome, grab a coffee, and let's get into it. Before we get started, I must tell you a bit of a disclaimer. The information that I'm covering today is purely for educational purposes only. It's not deemed as financial advice. I've never met you. I'm not aware of your financial standing. And obviously the information is purely informational only, but it's something that I'm doing as myself as an investor and my clients are doing. I've got clients that are buying their sixth, seventh property. They've been very successful. In fact, most of the time I've been spending with existing clients and helping them establish large property portfolios. So it's been quite exciting, but don't take this advice as financial advice. Seek independent financial advice from people that are qualified and are getting the results they actually want, which is the most important part of getting financial advice. Let's talk negative gearing. And, you know, last year there was a lot of talk about negative gearing coming back as well. When I say coming back, as politicians trying to get rid of negative gearing. Now, negative gearing is basically the ability to claim losses and expenses of an investment property, not only against the income of the investment property, which is your rental income, but also against your job income and other incomes. And this is what the Labor and the left wing have a big issue with, because they are convinced that the greedy landlords in Australia are taking advantage of prevailing circumstances and building up large property portfolios. And the common folk are struggling to get into the property market. I can tell you now, this whole debate is just complete nonsense. If negative gearing was scrapped tomorrow, it would have no impact on the market. The market would actually go down by 10% and then recover very quickly. Fund managers and overseas companies would buy up a lot of properties. Individuals would miss out, and obviously what would happen to those individuals would be that when they retire, they wouldn't be relying on investment properties as a source of income. Most of their income would be in shares, managed funds, and other investment alternatives. But ultimately, this thing about this negative gearing impacting and inflating property prices far beyond what they should be is a complete nonsense argument. There's been many countries around the world where negative gearing has been removed and it had a detrimental impact on the rental market. Ireland is the best example, where there was less than 100 properties for rent in the whole country. And remember, there's thousands of people that need to rent every year for different reasons. So what we're doing as landlords is providing a housing solution to the general public. And that's a very important part of negative gearing, because it enables the average income earner on 75,000 to 100,000 to get into a couple of properties and sustain them, and also to rely on them when they retire, so they don't have to be relying on the government pension, which might not even be there by the time you get to 65. The federal election is always won or lost on negative gearing to a large extent, and we see this with in 2019. I mean, we saw this with Bill Shorten losing the election on trying to scrap negative gearing. Negative gearing is here to stay. It's a tax outcome. It's not a type of property. So a lot of people confuse negative gearing with a type of property. It's simply a tax outcome. It's a very small part of investing. To me, it's not that important, but I can tell you personally, the impact that it has is on the lowest income earners who are trying to hold on to properties. People like myself with large property portfolios, if you got rid of negative gearing tomorrow, it wouldn't have no impact on me. In fact, I'd probably go out and buy more properties because the average household out there would be devalued by 10% probably instantly. And this is one of the reasons why Bill Shorten lost the election, because he was a left-wing person who doesn't like people having investment properties, obviously. And scrapping negative gearing, he thought would free up the housing supply part of the equation, which it wouldn't. Even if it did so temporarily in the short term, it will be completely absorbed in the market very quickly. But it wouldn't solve the housing issue that we have in Australia, which is quite a complex one. I'm going to do a YouTube video just on that topic by itself because it needs to be unpacked in a lot of detail because there's many moving parts to this and why properties that keep going up in value. The good news is for us as investors is that's what we want, right? So it's funny how people who are renting and they don't own a house, they want the property market to drop and devalue. The moment they buy a property, they want the property market to continue up and keep going, right? It's a funny thing with property ownership. So Bill Shorten's popularity sunk to a lowest level. He lost the election based on negative gearing. And the same thing is with negative gearing in 2024. We saw this a little bit resurfacing in the media where the Greens reissued demands to scrap negative gearing capital gains in a letter to Housing Minister Claire O'Neill. The Greens, which are always going to capture 10% or less of the general voting pool out there, look, they're very left-wing, they're neo-socialists. None of them have ever run a business. Their heads are in the clouds. They think everyone can hold hands and live happily ever after. And the reality is we need to have a system that rewards investing in risk. And that's what capitalism is based on. When you take a risk, when you invest, you should reap the rewards. And, this argument of, constantly of how is it that one person has 8 properties, another person can't get into the first one. It's a nonsense argument. It's like saying, why does one person drive a Mercedes, another one catches public transport? I mean, communism doesn't work. I know because I'm Polish. We escaped communism. I wish I could take all these lefties, all these green people into a time capsule and time machine and put them back into Poland in 1975 and to 80, and then they could see a reality of communism. Let me tell you, they'll be changing their minds very quickly. The Greens always. Adam Bandt is always against negative gearing. And I can tell you, if it ever gets scrapped, it won't have any impact on anything, as I mentioned before. It's not going to solve the housing issue in Australia. Australia is going to be very expensive because we have a very small housing industry and the capability of building houses is very restricted and limited in Australia. And we have a massive influx of population. Under the Labor, there's 1 million people that have just come into the country and we're not building 1 million homes a year. So it's the supply and demand that has to be addressed. And look, I'm a migrant. We escaped communism from Poland and we came to Australia in 85 with no money. And I'm all for migration, but let's not have, these ridiculous numbers come into the country because you and I will be paying for it. The road's already congested. You can't you can't see a doctor. You can't go to the hospitals. It's ridiculous what we're doing in Melbourne and Sydney. So we need to just build the infrastructure, bring a lot of skilled migrants in, but also allow for the infrastructure to be built so they can actually enjoy the quality of life we are all accustomed to. And this is the reason why Australia is such a great country. But this thing about the Greens always talk about negative gearing. Adam is an angry little man. He would love to scrap negative gearing. So if you vote for Greens, that's what you got to look forward to. I mean, these people are completely unrealistic. They've never invested in anything. They're anti-capitalists in my books. This whole thing would fail. Bill Shorten is also probably the worst prime minister that we've ever had in Australian history. He spent $390 million on the Yes campaign, and the answer from Australians was no. And then they said, did you understand the question? And yes. And the answer is no, because it's divisive. You can't have a reconciliation with yourself. I don't even know how. It's the dumbest thing I've ever heard. We're all Australians in Australia. It doesn't matter where you come from, especially the Aboriginal people. We are all equal, guys. I'm from Poland. I have friends from every country in the world. When you come here, you take on the values and the culture of Australia, and we all live together. in equilibrium and some kind of a peace. I mean, this is the reality of the country. I think the whole campaign was very divisive. But the biggest thing is, I'm here to talk about property, is rather than spending $400 million on a campaign, that money should have been used to prop up all the developers and building companies that have gone bankrupt since Labor came into power. And this was mainly because of the back of COVID-19 as well. Just so you understand the implications, and this is going to fuel. I mean, it's good and bad. It's bad because it's going to make houses more expensive in the future. It's bad because it's not going to be a catalyst for creating cheap stock. In 2023, we lost 1,500 to 2,000 companies that have gone bust. Building companies and developers in Melbourne, and which is huge. Last year, as a nation, this is for 24, we lost nearly 3,000 companies that are in the building industry. Now, when a builder or developer goes bankrupt, and unfortunately, I have seen this firsthand in Melbourne. I know some developers and builders, none of them that we've worked with, but I've just known through my industry that have gone bust. Just so you understand what happens, let's say you have a medium-sized builder, 20 staff, 30 staff. Not only does the builder developer go bust, and all the staff lose their job, what we don't understand is there's so many flow-on effects onto small businesses. The tradies, the bricklayer, the tiler, the landscaping company, the electrician, the carpenter, all these different businesses also immediately fail, because if that builder goes down, he won't pay out all the money that he owns to the other subsidiary companies or related external companies that are independent subcontractors. So when one company goes down, you might have 10, 20, 30 other companies being impacted by that immediately, and some of them don't recover. So the immediate flow-on effect on the economy is catastrophic. And I think we've lost so much talent. And by the way, a lot of these developers, builders, when they go down, they lose their marriage, they lose their house. I've seen extreme depression. I've seen people turn to alcohol and drugs. A lot of them never go back into the industry. So we have created, through COVID-19, through 4 circumstances, which is the lockdown, and Melbourne's been in lockdown more than any other major capital city, we have created an exodus and a massive decimation of an industry that might take a decade or two to replenish back to the original levels pre-COVID. And, and this is the thing, the government wants to build all these houses and they want to rely on the private sector to deliver these houses. Well, the private sector has been decimated and the government never stepped in to prop them up with tax-funded loans. I mean, I would be happy to spend $400 million in interest deferred or even interest-free loans to developers and builders rather than spending on a stupid yes campaign, which is the dumbest thing I've ever heard. So, the government's completely useless in Australia. I mean, and this is part of the reasons why living costs and expenses are so high for everyone. There's 1.2 million homes by 2030. Who's going to build them? It's ridiculous. It's a ridiculous notion. They're never going to get there because there are so many constraints with building properties, especially at the council level. You can't just build estates. Getting infrastructure into a state, roads, connections, power, sewerage, water, it takes months and years of planning and execution. And without the private sector, they're never going to get there. And the government is hopeless at building anything themselves, as you know. So they're never going to actually step up and take over some of these projects. They're going to make an incentive for the private sector to build properties. I was speaking to a developer just over the break. I was having lunch just here in Brighton at the deck with a developer, and he builds apartments. We don't obviously sell apartments. I don't source apartments. I don't believe in them. But he told me, because there was a big thing about Brighton, parts of Brighton potentially being rezoned for high density projects. And he would definitely jump in because he lives in Brighton. He knows the area really well. He's a very successful developer. The family have been around for 3 generations now doing apartments in Melbourne, in the Bayside area and the eastern suburbs. And I said to him, what if the land was given to you with development approval? Would you build it? He says, well, the problem, Konrad, is for me to make money on apartments, I need to be around 12 to 14,000 per square metre, depending on the level of fixtures and fittings. And that means for a 2-bedroom apartment, if you're looking at something like, 70 square metres, you're looking at about $1 million. And for 3 bedrooms, you're looking at 1.2 to 1.4. So the problem is I can build them, but who's going to be able to afford to buy them? And this is the issue. The government they don't crunch the numbers and they don't understand the reality of the market. And this is one of the reasons why we're never going to deliver 1.2 million homes. And if you're going to keep building homes in external suburbs and the fringe suburbs of Melbourne with no infrastructure and roads or anything like that, well, what's the reason for that? I mean, no one's going to benefit from being stuck in a suburb where they can't get to the city, or it takes 2 hours to get to the city, and there's no hospitals, childcare facilities, transport. I mean, you're just going to be developing slums of the future. So the problem is that all these kind of promises are just completely meaningless. And the reason is because these people have never been in the private sector. They've never held a job. They're career politicians. They're autocratic theorists. And there's no substance to anything that they say. All they do is they try to win the next election and make promises that they keep breaking. And what's happening is every policy that Labor has had has created an inflationary effect. In fact, the IMF, International Monetary Fund, has told the government that their policies are inflationary, and this is why inflation has been so high, and this is why the cost of living is so expensive in Australia, because they haven't addressed inflation. Now, I don't want to make this up around about politics, because all the stuff I'm telling you is relevant for you to understand as an investor, because there's a flow-on effect into the property game. It's the only reason I'm talking about this information. I'm not really here to talk about, obviously I'm a Liberal supporter. I've always been Liberal. For me, it's a democracy. I respect anyone's views. If you're a Labor supporter, great. Personally, I believe the best way to govern the country is to have 2 terms of Liberals and 1 term of Labor, so they can spend the money and bring up, the lowest income earners and build schools and roads and all the other stuff they do, because they love building infrastructure, just like the Bruce highway upgrade now for $7.2 billion. And then Liberals will come in and prop up businesses and actually start because they understand what drives the country, which is small to medium businesses. Look how many bankruptcies have eventuated in Melbourne and Sydney. How many cafes, restaurants have closed down since Labor's been in power. This is one of the problems. Labor is fueling inflation, and inflation is creating an abnormality in the cost of living expenses in Australia. And what happens is, on average, we are seeing increases in interest rates. We've had 13 increases in interest rates, and you're paying extra for the same property, which is on the mortgage, of $25,000 to $50,000 for the average mortgage, which is killing everyone. And as a result, this is what's happened since May 2022. Health up 11%, education 11%, food 12%, electricity 14%, even after rebates. Housing 15%, rents, gas. Now the thing is, inflation is a friend of property, because under high inflation, property prices rise. The problem at the moment is serviceability is an issue. And I'll cover that and I'll unpack that later on. We'll talk about interest rates. But we've had the worst scenario in Australia occur, where we had a fall in disposable income, the worst in the world from March 24. You can see that negative 8%. So for $100 in spending power, you've lost $8 in real sense in Australia in 2000 and in March 24. This is figures based on 22 March to 24 March. So where most nations, industrialized nations, their buying power has gone up or is flatlining at the very least, Australians have actually lost 8% in real terms, because of the way we've been mismanaged by the Labor government. It's actually the worst since the 1990s, where I remember in 1990s, I was at uni, I was at Monash University, shooting pool and drinking beer at the tavern and, just laughing at the whole thing. It was the biggest waste of time. But anyway, I remember in the 90s, Victoria was known as the rust bucket state of Australia, and there was completely no growth between 91 and 95. There was a lot of turmoil. Negative gearing was going to get scrapped. There was nothing happening in the property market. People saying this is the end of property appreciation as we know it. Port Melbourne, you could have picked up a nice house for $250,000. Now they're $4 million. But anyway, despite all this, it flatlined. It went sideways for 5 years, and then we had the biggest property boom we've experienced probably in the history of property. And when we hit 2001, 2002, we had 20% capital growth. Some suburbs went up by 40% in 1 year, just so you know. So it just completely went nuts, like Elwood, for example, Middle Park, Port Melbourne. So I can feel at the moment the reason I'm giving you this history lesson is I'm not here to do any kind of political commentary. This YouTube channel is purely based on property. But the reason I went into all this effort to show you what's happening in the economy, not just to bag out the Labor Party, I just wanted to tell you that because I'm now 48, I've been around the block a few times, I can see very strong similarities between the early 90s and right now, what's happening in the economy. And I feel it in my gut, we're about to go into a massive property boom. One we haven't seen since 2001, 2002, 2003. It's going to be shocking, I think, how fast property will go up and to what extent. And people will be completely shocked. And then you're going to have the other side of the equation, which is once again, the left wing, oh, we can't, our children can't buy property, all these things. They can never buy property. Okay, it's always been expensive. But I can see it in my bones. So you've got probably 12 months where we're going to have stagnation or consolidation of the market, and then it's going to go off, and then it's going to happen with or without you. So you're going to have to make a decision whether you will be part of it or not part of it. And hopefully the Albanese government will be well and truly behind us, and we'll have a new Liberal government. Both we need federal and state change of government because what they're doing is just ridiculous. And look, the proof is in the pudding, guys. If you look at the bankruptcies, we've had the worst years of business failures ever in Australian history since the Albanese took office. It's just ridiculous. I went down to Chapel Street in Melbourne just the other day, just for lunch with a friend of mine, and they live on Chapel Street in the penthouse in a high density apartment, and beautiful penthouse, amazing views, city views and beach views. But the amount of cafes that were shut. I've never seen it in Chapel Street, and this is Creagh and Chapel Street, one of the most busiest intersections in Melbourne. The amount of density now of apartments there's thousands of apartments. You've got thousands of kids who just want to drink coffee all day and sit around on the laptop, and the amount of cafes and burger places that have shut down is evident of how bad the government is. Because, and I've seen some cafes that have been around for 20 years, guys, have shut down now in the last few years. It's just been incredible, and it's all because of inflation, all because of cost of living. People are budgeting. People are not spending money on coffee. They can't afford to spend $6, $7 for a cup of coffee. They'd rather just stay home or go out and not spend money. And this is what's happening. People are struggling with just paying bills because everything keeps going up in value. And these businesses are shutting down, and because they're shutting down in large numbers, we're paying for it. So this is the outcome that we're looking at. Yeah, that's one bit of a rant about the government. It's funny because now the other day it was funny because I don't watch TV anymore. I can't handle it. I just end up screaming. And when I see Penny Wong and Albanese on ABC, I just start screaming at the TV. And my wife's going, "You're just turning into this old person now that just keeps screaming at the TV," because I can't handle it. So I just will read the Fin Review, and I subscribe to specific media that has to do with property investing and finance. But the other day, unfortunately, I was watching ABC News and I lost my shit when I saw Penny Wong and Albanese. But that's enough of me. Let's talk about the property market. A bit of background about myself. So I've wasted 4 years at Monash doing a business degree, nearly did an MBA, more bad advice. I'm a real estate agent, mortgage broker. I've got a diploma in financial services, financial planning. But the most important thing, guys, is I'm a property investor myself, just like you. I've built up a large property portfolio here in Melbourne, and everything that I'm telling you is real stuff that's happening right now. I'm on the ground talking to developers, financiers, mortgage brokers every day, and investors. So the information that I'm bringing to you is real. It's made to do one thing, to make you money and avoid mistakes. And that's the whole purpose of my YouTube channel. As I mentioned before, I've got 2 books out, which is Real Estate Investing Made Simple and Property Finance Made Simple. Both of them become #1 bestsellers on Amazon and various other bookshops multiple times. I really want to thank you guys for supporting me and buying those books. It's always, a bit nervous when you write a book, hoping someone buys it apart from your mum. If you want to get a copy, by the way, just jump onto realestateMadeSimple.com.au. You pick up the book, plus it gives you a free online video course, and also bookonfinance.com.au. We can learn how to pay off your mortgage in record time, and how to build and structure your property portfolio from scratch. Also, what I'm going to do, because you're here today watching this YouTube video, I'm going to give you access to my online video course, absolutely free. Look, it's a few years old now. It's probably 3 or 4 years old. Nothing's really changed, guys. The only part that's changed is the market updates. So if you take the market updates out of it and just watch these videos, the rest of the stuff is still the same. How we structure our portfolios, which suburbs to buy, which suburbs to avoid, etc., etc. Let's look at January figures. So let's get into it. And I didn't want to do an update unnecessarily because I felt nothing was happening in the market. It was just going sideways. It was annoying. Melbourne went down 4% for the year, between 3 and 4%. I was talking to a lot of agents that I know of, and they're saying the general market out there is horrible. There's an exodus of real estate agents out of the industry. They couldn't get sales. Auction clearance rates, official, were around 60%. But let me tell you, the reality is around 40%. A lot of agents don't actually record real auctions and auction results. So let's get into it. Let's unpack the property market. The first thing that I want to always mention is this, and I know I sound like a broken record. We have a $11.1 trillion residential real estate market. Our outstanding mortgage debt combined is 2.4 trillion. That's an LVR of 21%. So you have 21% gearing. When economists say we have a lot of gearing in the industry, people have a lot of mortgages, you have to go back to Monash and bring your certificate in and say, I did a diploma of economics, it didn't work, I don't know what I'm talking about, and get your money back. Because 21% debt level is extremely low. That means, by definition, we have 79% equity in the market. That's the most resilient, lowest debt market I've ever heard of in virtually any asset class. So there's no gearing. The gearing is extremely low. The problem is there's gearing that's concentrated in the fringe suburbs where people have borrowed 95%. And in the best suburbs, the market's virtually paid off. There is no mortgages. But the gearing ratio in Australia is very low. I keep hearing these economists saying we've got too much gearing. People have borrowed too much money. No, they haven't. No, they haven't. Individually, maybe, but individually doesn't make a difference. As a collective market, you have an $11.3 trillion market with 2.4 trillion in mortgages. This is for the last 3 months. This is from January 25 data. After holding steady in October, November, home values fell 0.1% in December. This saw the quarterly trend shift into negative territory for the first time since 3 months to February 23. Now, market's gone sideways, negative 0.1%. 12 months, that's for 3 months, but 12 months, 4.9%. However, you got some states that are going up, some are going down, but Melbourne and Sydney are the most important two states. And I can tell you now the whole market's gone sideways. Within the market, though, guys, there's always going to be suburbs and properties that will go up. Melbourne has 321 suburbs. They're all very different from each other. There's different demographics. There's extreme clustering of demographics in Melbourne and Sydney. Brisbane doesn't have that clustering. So, in terms of what's happening at the moment is the market's going sideways. It's quite boring. It's time to buy. It's time to consolidate. It's time to, organize your taxes and refinance properties and, think about your next move. Home values increased 4.9 over 12 months. December below 8.5. First recorded over 23 calendar year, but more positive year as a result compared to 22, where values fell 4.9, and quarterly 9.9. Now you can see there, if you look at Melbourne, we did negative 1.8% for 3 months. Sydney's negative 1.4%. Brisbane's positive 1.3. Adelaide's 2.1. Perth is 1. Darwin 0.6. Hobart 0. Canberra 0. But look, 75% of the market is Melbourne and Sydney. And then Brisbane's not a huge market, So if you look at what's happening in the major capital cities, this is why I like the trend line here. It's just going down and sideways. Okay, so this is for combined capitals and combined regionals. And remember, regional cities mimic major capital cities. There's just a delay of around 12 months. And that's pretty much it, what happens. Over 12 months, as I mentioned before, Australia went up 4.9, combined regional 6, and combined capitals 4.5. But Melbourne went negative 3%, Sydney positive 2.3. But it also depends on when you measure the market. But if you look at normal suburbs in Melbourne, if you ask me what we're doing in the last 12 months, we just went sideways. Sideways and a little bit down. Now, some suburbs, and I'll show you today, actually went up really well. But for most part, we're just going sideways. Remember, the major capital cities, Sydney, Melbourne, Brisbane, and Adelaide, are synchronized. And then you have Perth, Hobart, Darwin, and ACT. They're very different. But you can see there, as a general trend, if you look at December 22 onwards, it's a consolidation pattern. It's just the market's going sideways. People can't borrow money. They're stressed about bills. Inflation's out of control. Headline inflation now is between 2 and 3%. There's going to be rate cuts in the future. No one knows when. I don't know if it's going to be in the next 6 months or next 12 months. It doesn't really make a difference. It's going to happen because it's unsustainable. But people don't want to know about investing. The only people that are investing are first-time investors and people that have 7, 8 properties and massive buffers. But the average person out there doesn't really want to invest at the moment. My clients, I'm seeing a lot of young people that are like 130 grand working for Telstra. I'm just giving an avatar example. And they're paying 30 grand in tax or 20 grand in tax, and they can buy one property for 750 and wipe out their tax. And everything's fixed. They have an exorbitant lifestyle. A lot of them don't have cars. They just rent an apartment in the city. So they're coming to me and buying one property. I'm seeing a lot of those. First time, 21, 22, 23, 24, educated kids who are doing rent vesting. Super smart. And they're just getting into the market. And then I'm seeing people that are like 6, 7, 8, 9, 10 properties. And they've got massive buffers, $1 million in equity, $2 million in equity. So they can afford to absorb that buffer when the interest rates are 6.57%. And their serviceability is still fine because they've structured themselves through trusts. They know what they're doing. And they're the ones that are buying and adding to their property portfolio. And they usually buy at the bottom, which is what's happening now. But the average punter out there, they're out. They're worried about paying for their insurance and living from paycheck to paycheck. They're not even thinking about the future or investing in property. They're trying to just get through the week. That's what's happening in Australia at the moment. If you look at the major capital cities in Melbourne, I want to focus on. So you can see the negative from if you look at the percentiles, you've got the lowest percentile, which is 25, which is the cheapest properties, and then you have the 75 percentile plus. They're all negative 1.2, 1.2, and then 2.4. When you have the next trend in the property market going up, the 75th percentile always goes first. The mansions always go first, then the middle sector, the 50th percentile, and then the cheapest properties get dragged up. So Melbourne always starts off Creagh, Brighton, Hawthorn, Kew, Canterbury, Essendon, they boom. Then the middle suburbs come in second, and then the cheap stuff, goes up. Truganina, Tarneit, Berwick, Pakenham, all the fringe suburbs, they always come up as well. They get dragged up with the market. Housing cycles, well, we're just going sideways. It's negative. It's moving sideways. Sydney's down. December 0.6 over the quarter, negative 1.4. 12 months, 2.3. Melbourne's the same, 0.7, 1.8, negative 3. You can see the pattern there, and it could go down even further. I wouldn't be surprised if Melbourne goes negative this year. People saying it's going to go positive 3 or 4%. The banks, they never listen to the banks because Westpac and ANZ and NAB, those experts, and they're getting massive salaries, 9 out of 10 times they get things wrong. So, in fact, if you just went against what NAB says, you'd probably be more right than wrong. But I wouldn't be surprised if the cuts this year don't translate into any activity in the market. It could just go sideways. It could be another year written off. Remember, property investing is about a 10-year time frame. The market cannot just go up and up and up and up and up indefinitely. It has to have a breather, and we're taking a breather in the market. But it's going to go up and it's going to boom. There's no question about it. Brisbane's boom. Now it's going down a little bit. It was unsustainable. It had a slight boom. People cleaned up. A lot of people moved to Brisbane and Queensland from Melbourne and Sydney because they're just affordable. I know a lot of friends and colleagues and people that I know of that are friends of friends that have moved up to Queensland, Gold Coast. They got rid of their mortgage in Melbourne and bought a property half the price on the canal, and now they've got water views. And who blames them? I mean, look at the weather in Queensland. You just got to put up with the bogan factor, but I mean the weather's fantastic. Let's get real. Melbourne's weather is shocking. It could be raining, it could be sunny in the morning and raining and hailing at night. it's the worst. Adelaide, no one cares. No one cares. Perth, they're all down, and Hobart sideways, and Darwin's consolidating as well. You can see everything's kind of going sideways at the moment, and that's pretty much the whole market. That's been the message. Sales and listings, well, the same story there. In 24 calendar year CoreLogic estimates, there were 531,000 national sales. Although up 8.3, sales activity over December quarter were down 1% compared to the final quarter of 23. In Melbourne, yes, the volume was up by 13.3%, but it's going sideways. A lot of suburbs in Melbourne, people are only selling if they have to, if they're upgrading or they're forced to sell. There's nothing special on the market either, because I look at a lot of these mansions that are around, just because, not that I can afford any of them, but I just like looking at properties. Like you look at Lamborghinis and Ferraris and Porsche 911 Turbos for $500,000. I like looking at cars and expensive property and expensive cars. But there's nothing really exciting on the market, to be honest with you. Like you look at Creagh, Canterbury, Hawthorn, Toorak, Brighton, like you look at the high-end mansions, nothing on the market. Couple maybe. So it's just sideways consolidating, Option clear rates average. Median days on the market is a very good indicator of where kind of gauging the pulse of the market. And if you look at December 23, which is the grey bar, in Melbourne, it took 31 days to sell a property. In 24 December, it took 38 days. So it went from 31 days to 38 days. So it's getting longer and longer and harder to sell the same real estate. Combined capital cities in Australia, it's now in 24. It took 33 days to sell the average house compared to 28 same time last year, or the previous year, 23, I should say, versus 24 December. Combined regionals, same story. Although the gap isn't as wide, 40 days in 24 versus 37 in 23. And then for capital cities, 29 days in December 24 to sell an average house versus 25 in December 23. So once again, you can see this pattern of consolidation going sideways. And that's going to be moving, and there's going to be a breakout eventually. But it could go down before it breaks up as well. I would love to do Japanese candlestick analysis on the property market. Unfortunately, it just doesn't work. I've tried it. It doesn't really. There's too many black swan events. There's too many policies. I mean, you can change the monetary policy, has immediate impact on the market overnight. So I wish candlestick analysis worked on the property market, but it doesn't. Vendor discounting as well. It's increased from 3.4% to 3.5 for Melbourne. If you look at December 24 versus 23, 3.7%. So it's going sideways, which is very slight discounts. That means the property was discounted to sell it. It could be passing at auction. It could be a private treaty sale. It's just going sideways. It's a pretty boring market, guys. There's not much. This is why I haven't done an update video for the last 6 months, because the market's just going sideways. It's waiting for a breakout pattern. There's nothing really to talk about. Listings are going sideways. Listings are low, negative 10% combined average. People are not listing properties because remember, when you list a property, you got to move somewhere else. You can't. No one sells a house and just becomes homeless. You have to line up another property. And if you're struggling financially, if you're watching your budget, if you're living from paycheck to paycheck, the last thing on your mind is to upgrade your house, because then you got to buy white goods. It's a very expensive process, not only moving, but just all the stuff that goes into the property. So now at the moment, people are just sitting where they are and just trying to get through and seeing what's going to happen this year with the Trump government in America, and obviously with potential election and change of government in Australia. Once again, listings as well, record low listings, negative 0.8% in Australia. For capital regionals, negative 2.2. For Victoria, 2.6 up, because a lot of fringe suburbs now are in mortgage stress. People are liquidating properties. But if you take out the fringe suburbs, you'll see that the listings are low by around about 7%. Some suburbs have an excess stock and they've got a lot of apartments on the market. Land tax has really killed a lot of people's portfolios, and people liquidating. I would say uneducated investors are dumping properties because they weren't structured correctly or they bought the wrong type of property. Auction clear rates, I mentioned before, 60%, 62, 65. Combined of 55.7, ending December the 15th, which was the lowest since 2022, which was 51.9. 51.9 means that out of 10 houses, 5 are getting sold, or 4, and 6 are getting, passed in. I can tell you now, these numbers are a lot worse in reality. In some suburbs in Melbourne, we have auction clear rates of 40%. People are not bidding, they're not turning up to auctions. Vendors are unrealistic about what their house is worth. Every vendor reckons their house is worth $100,000 more. I've never seen anyone that sets their actual vendor reserve at a conservative level, where the agent goes, "Are you sure you can get another 200,000?" "Oh no, we don't want it." We know our house is only $1 million. We're realistic vendors. That's never going to happen. If the house is $1 million, they want 1.3. So it's just the way humanity is. So the market's not meeting their expectations. That's why we have massive auction clear rates at a record low level. And that's why agents are not making money in the industry. And there's too many real estate agencies set up anyway, and they're going out of business, or they're struggling. Which is what it is. It's a process of consolidating real estate agents as well. A lot of the deadwood will leave the industry, and when the industry comes back online, which could be end of this year, you're going to have the ones that make it through this period come out the other end, and they'll clean up again, and you can get your new, M3 and AMG Mercedes-Benz again. Rental market. Rent's been really strong after COVID. They boomed, and now they're kind of finding their own way. I mean, rents peaked and they went up by 10% in 21, 22, 23. We've seen suburbs in Melbourne, they've gone up by 30 to 40% in 1 year, which is insanity. We've never seen that before. But generally speaking, rents keep up with inflation. The National Rental Index increased by 4.8 in the year to December. A notable decrease from 8.1 observed in 23, 9.5 recorded in 22. The net overseas migration projected to normalise, and the average household size expected to continue to trend towards pre-COVID levels. Rental growth is anticipated to be moderate further in 25. Well, if you bought in during COVID, which I was selling to my clients and telling them you're going to get massive rental increases, if you watch some of my YouTube videos, those people have cleaned up. But remember, what happens after that is there's an inverse relationship between rental yields and capital growth. So if you have $1 million property, and let's say you're getting 5% rental yield, 50 grand a year, if the property goes to 1.5, your rental yield still stays the same. He actually devalues your rental as a percentage of the value of the property, right? Or let me put it this way: if you're getting $500,000 property, you're getting 5% rental, $25,000 per year. If the property goes to $1 million, your rental yield goes down to 2.5. So there's an inverse relationship between capital growth, appreciation, and rental yields. So rental yields boom, and then they drag up because they're so high. When the property gets 6.57% rental yield, it goes up in value, and the rental yield equalizes at around 4 to 4.5%. So rent will even go down even further, in my opinion, in the future, especially with apartments. So it's just what happens. You got to look at rentals over a long period of time. This thing about rental yield, and also depending on when you buy the property, you could have a rental yield of 2% up to 6%. Same property, different part of the cycle. So when people talk about cash flow positive property, I said, well, it depends on how much deposit you're putting in and when you're buying it, because you can have a property that can be changed from a cash flow positive, neutral, to cash flow negative in 10 years, depending on when you buy the property and which part of the cycle you're buying it into. But that's not why we buy property. Property investing has never been about cash flow from the rental. It's always been about equity appreciation. But you can borrow the money, you can take equity out of a property and buy stuff with it. You can buy cars, holidays, lifestyle. That's what property is all about. It's all about capital appreciation and the ability to extract money out of property. So rental yields now are kind of consolidating. Once again, just going sideways. Nothing special there. Melbourne, 3.7%. Sydney, 3%. Brisbane, 3.6%. Dwelling approvals, consolidating pattern once again. Just moving sideways, up and down slightly. Nothing exciting. Investors are higher in the market. They're refinancing. They're buying properties. But really, the whole market's going sideways, guys. I don't know what to tell you. I wish it was more exciting than this. We have seen an increase in finance because people are refinancing. Owner occupiers are low, but investors are high in record numbers. And they're spending more money by refinancing, getting equity released, using that equity to buy more property or trading shares. So investor lending has comprised of 38.3% of new loans secured in September, down slightly from the recent peak recorded in July, when it was 38.7. But investors still are the most aggressive people that refinance. Owner occupiers, sometimes they don't refinance for 5 years. They don't think about that they could refinance actively and save money. Investors are conditioned that you need to get the best deal. You should be reviewing all your loans every 6 to 12 months. And if you can save money, just think about this, guys. I know I hate paperwork as well. I understand. Okay. It's tedious, it's pay slips, tax returns, utility bills. But if you can just do, let's say it takes you 5 hours of work, which is ridiculously high, right? It's just like 5 hours of actual work, and you're going to save $10,000 over 12 months on your loan, or $5,000. That's like $1,000 an hour. Like, when was the last time you made $1,000 an hour? Like, that is the best use of your time in the whole year. That's the highest and best use of your time, literally, if you're selling time for money, which is most employees are trading time for money. Like, when was the last time you got paid $1,000 an hour? Think about your job and do a bit of an activity and work out how much you get paid per hour. And, the average hourly rate will be, 30, 40, 50,000, $50 per hour. No one's getting $1,000 an hour. My barrister's not making, he's making 1,500 a day to 2,000 a day, not an hour though. My lawyer makes $600 an hour. The average lawyer makes $350 an hour, so think about that as a you got to think of that context as a business model. First home buyers, sideways. Hopefully the government will do some incentive in the future that will make the reason they're going sideways is serviceability, guys. This is the problem: is interest rates. The cash rate is sitting at 4.35%. Variable rates now are 6.5 to 7, but the benchmark assessment rate is 9% P&I. And this is the problem. People just can't service debt levels, and people on very good incomes just can't get into the market. On average, guys, and I'm really just generalizing here, you can borrow 6 times your annual income. So if you're on 100 grand, you can borrow roughly $600,000. That's very low compared to pre-COVID, where you could have borrowed 1.2 million or $1 million, depending on if it's low doc or full doc. So, people's serviceability is crap at the moment. And what are you going to buy for 600,000 in Melbourne or Sydney? Nothing. You're going to be buying a garage somewhere. So the reality is, that's the current interest rates are having a massive impact on people's ability to borrow money, and that's why they're not borrowing money, because there's nothing worth buying for what they can borrow. So they're sitting put, consolidating. The only ones that are buying investors with large property portfolios to medium, and also those young kids getting into the market that are smart. Housing credit, yeah, it's going sideways as well. You can see their consolidation pattern from kind of mid-22. So nothing they we're talking about, and equity, the whole thing keeps going up. Rentals are interesting, because if you look at September quarter, this is 2024, specific suburbs rental yields have gone up massively. Like Belfield, for example, 33.9%. I'm sourcing a lot of properties in Belfield. Belfield's going to boom. It's going to go crazy. Toorak, 30%. East Melbourne, 29.4%. Heidelberg West and Heidelberg Heights, they're going up by 30%, 28.7% increase. So those people that are locking in those townhouses, guys, they're going to clean up. My best 3 suburbs that I'm focusing my energy on right now are gentrification suburbs, which is Belfield, Heidelberg Heights, Heidelberg West, because they're changing in their nature. But there's a massive hospital there, the Austin Hospital, which employs 12,000 people, and adjoining hospitals, and they're all renting in the area. They're all renting in Heidelberg Heights West and Belfield. So if you want to have aggressive increases in rental, they're the suburbs to focus. Kingsbury, 25.9, Jacana, 25.8, Noble Park North. Wouldn't touch Noble Park. I wouldn't even drive through Noble Park North in my car if you paid me. So forget about that suburb. Seaholme, Donvale, lovely, 21.9. Dandenong, 20%. Burnstone, Maribyrnong, Murrumbina, good, 20%. Yallambee, fantastic, 20. Killer East, yeah, okay, 20. Noble Park, forget about Noble Park, don't touch it. Avoid like a teen arena concept. Oak Park, same thing. Whittlesea, Braybrook, and Altona Meadows. Do not go there. Altona Meadows, avoid it like a PDD party. This is for units which are apartments, Aspendale, Noble Park, Caulfield South, Dandenong, Clayton. Now, this is just one measure. I just want to show you that even in Broadmeadows, which is like probably the worst suburb in Melbourne demographically. By the way, don't send me emails. I don't care. I don't make these suburbs. I don't put these people in these suburbs that can stab each other at night. But Broadmeadows, 17.6% in rental increases, $450. So even the worst suburbs, Glenroy, another suburb that's going through gentrification, and Oakley East, which is old Clayton, 17%. Even those areas, rents are going crazy because we have no new stock coming onto the market. So that's the thing. So people are under the pump. There's a lot of pressure there, and you can see that across all suburbs in Melbourne. God knows why people would rent in places like Glenroy. We can go to Ormond and get an apartment for the same price per week. Ormond Tone. I don't know. I understand it. It's just crazy. Where are we in the property cycle? The cycle is very cyclical. Peak of the market, decline, bottom, and growth. Heron Todd White, latest December month in review. Melbourne is going into declining market. So it's going to declining. This could be very short-lived though, and then it will be going back up again into rising market. I think the boom will happen. And look, there's so many moving parts this year. I don't even want to call it, but my gut's telling me it's quiet before the storm, and it's going to happen definitely. It could be, we need a few interest rate cuts. We need a change of government and clear direction and housing policies, but it could happen mid this year, it could happen end of this year. It's going to happen. Okay, it's going to happen because it's the pattern that's been repeating itself in supply and demand. The best time to always buy properties is around about 7, 8 o'clock because we have a rising market. From 9 to 12, it's too late to buy. You're just overpaying, and then you just want to hold on to properties and realize that growth. Most investors, what they do is they refinance at the top, do nothing on buying investment properties, increase rentals at 6 o'clock, and then buy more investment properties between 8 and 9. So it's counter-cyclical investing, and then you're buying just before it booms, get that equity in 12 or 24 months, unlock the equity, and then go again. Yes, the best time is always to buy at the bottom of the market. I've called the bottom many times, November 22, but you know what? How many people got there in November 22? And it's the bottom of the market. I said on my YouTube video, guys, I'm calling it, it's the bottom of the market. And number one is a lot of people can't borrow money. Number two, it's the wrong time in their life to buy anything. And also, there might not be anything worth buying that they want. So you might wait for 10 years to get to this magical moment in the market, if you want to time the market, and then you get there and you'll be very disappointed. That's why never time the market, guys. It's time in the market, never time the market. Not because you need to buy whenever you can. It is very complex to buy property. Serviceability is always an issue. There's also life that impacts your ability to borrow money. Buy as much as you can. Stick to the fundamentals, quality over quantity. And when the market goes up, you're just going to look very smart. In fact, in the last year, these are the capital growth changes. Ivanhoe, 17.3%. Diamond Creeks, 13.2%. Coburg North, 12.8%. Parkdale, 12.4%. Ringwood, Ringwood North, which is practically Donvale, 11.6%. Bendigo Regionals, 11.4%. Newtown, Geelong, 10.8%. Hallam, 10.4%. Greensborough, 9.4%. Eltham, 9.2%. So even though the Melbourne market did negative 3%, don't think that every suburb in Melbourne actually went negative 3%. No one gets together every week as a collective, body from the suburb. Go, all right, guys, everyone hold their prices steady, waiting for negative 3% for 12 months. These markets are all independent. And so in Melbourne, you have suburbs that do double-digit growth, like Ivanhoe, over 12 months for different reasons, and it's not a cheap suburb, by the way. I've sold many properties in Ivanhoe for $1.5 to $2 million. So it's one of these things where you just got to pick your markets, understand how fragmented the market is, identify your chosen suburbs, and then go hard in those suburbs. Become an expert on those suburbs. Your job as a property investor is to become an expert on 3 to 5 suburbs. Just go to extreme depth in due diligence and research, know everything about the suburbs, and you'll become untouchable. And when you can make enough money in those suburbs to then replicate that knowledge into another three suburbs, Remember, guys, 20 years from now, the average home in Australia will cost $6.3 million in just 20 years. This is from Aussie Home Loans and CoreLogic. Projections show median prices will reach in Sydney by 2043, up from 1,030,000 last year. The Aussie Home Loans and CoreLogic survey predicts average prices will hit 5.8 million in Melbourne, 2.9 in Canberra, 2.5 in Perth, 2.3 in Brisbane. The biggest increase in Melbourne, guys, 5.8 million from 800,000, right? 880s, around about there. Let's call it a million. What are you going to do to be part of that market? We're looking at Bitcoin here for $1,000 and it's trading at 100,000 right now. This is where we are. Melbourne is like Bitcoin when it was trading for $1,000. You got to understand, guys, the most important thing to understand, this is going to happen with or without you. It doesn't need your specific individual money. Your loan, whether you're buying a property for $1 million or $2 million, isn't going to impact anything to do with this. It's just a question of, are you going to get enough information and skills and contacts to take advantage of what's happening or not? Bitcoin's going to go through the second halving, another halving again. It's going to boom this year. It's going to happen with or without you. It doesn't need you. You know, like whatever you can contribute will be insignificant to the volume that institutional companies are pumping into Bitcoin. And this is the thing. And now people saying it's a scam, it's going to crash. There's always two different opinions in the market. That's what makes the market work. People think something's expensive, something's cheap, and then there's a meeting place in the middle. And that's what makes the market. Remember, guys, be fearful when others are greedy. Be greedy when others are fearful. And the Australian impending property boom is going to happen with the average cost of a home will surge to 6.3 million in 20 years' time. You're going to be wishing to go back to 2025, in 2045, going, man, if I just bought properties in 2025, I would have cleaned up. Now they're worth 6.3 million. I could have bought them for $1 million. This is the Australian House Index since 1880. Yes, there are bumps in the road, but I can tell you now, it's an upward trending market. It's all on the back of population growth. If we had no population growth in Australia, I would liquidate my entire property portfolio tomorrow and put it into shares, cryptocurrency, and commercial property. I would get out of the residential market. As long as there's people coming in and there's an inefficiency in the market, meaning we can't supply them quick enough with houses will keep going up in value. It's as simple as that. It's supply and demand. Blocks of land in Glen Waverley used to cost $5,000, guys, when the subdivision was, this is from the newspaper that I found, deposit of $200. You could get a new house in Melbourne for £3,375, built in Glen Waverley in the 1960s. You know, this is the reality. Now, yes, it could have gone down to £3,000, but overall, they've gone up multiple times. That's it, guys. That's it for my video. Now, if you're interested in learning more, a couple of things I want to cover. I'm running my Fast Track weekend in Melbourne again. I'm only doing a few this year. I'm just focusing on my established clients. I'm spending more and more time looking after individual clients. If you want to work with me one-on-one, I can help you build up a large property portfolio. It's very rare, guys, that you can work with individual people like myself one-on-one. Most companies have a speaker and they teach property investing, but you never work with the owner. You never work with the actual person. You have a consultant who's an employee. I work with my clients hands-on. Same with Cameron Fisher, same with Stephen McClutchy. But I'm getting more and more busier. As I get busier, I'm doing less live events because, quite frankly, I just don't need more clients, and I'm nearly at capacity. I do have room for more clients, and that's why I'm running the event in Melbourne. But rather than running one event a month, I'm doing now 2 or 3 per year, and that's pretty much it. And eventually, I'm going to retire and stop doing this whole thing. I'm going to be living in Italy 6 months of the year and in Poland, and then in Melbourne. I'm going to be chasing the endless summer, as they call it, and maybe a bit of skiing in Poland as well. But, you know, you get to work with me personally. If you want to learn information, definitely I encourage you to attend my 2-day live event in Melbourne in my office in St Kilda. Where I'll go through the whole process of how successful investors are structuring and setting up large property portfolios, the kind of property portfolios that will leave you building a legacy for future generations. And if you're poor, if you've come from humble background, maybe you're the person in your family that's going to become the rich person. Maybe you're going to be the one that breaks the pattern, and you're going to become that uncle or the cousin or the brother or the son that started it all for everyone. So if you want to have that knowledge of how people are buying 5, 10 properties, definitely feel free to attend. Tickets are $47. Plus, you get a hard copy of my book, which is kind of like a manual of real estate investing made simple. It's a big book. It will stop a bullet, this book. So if you're in Hallam or in Glenroy or Broadmeadows, you can sleep with it, like that. And then if they try to stab you can hopefully survive. I don't guarantee it, by the way, but I think it's just physics. So $47 plus you get a hard copy of my book. Catering and food is all inclusive. We don't make money out of the event. It's purely just an exercise to help people get into the property market. And we just cover our overheads with $47. So, you get a book, you get food, but we're not going to serve you 5-star food. It's just basic, Subway and sandwiches and biscuits and tea. You can bring your own food. You're more than welcome to. But it's a great event. It's all jam-packed with information. Also, guys, if you want to get the home study, just scroll below. There's a link there. You can start watching it today. It's actually a recording of the 2-day, but it's from a number of years that have passed. Now, fundamentally, nothing's changed. Yes, micro level things have changed, interest rates and the market, but in the big picture things, it's same suburbs, same structures, nothing's really changed. And you can start watching it immediately. And it teaches you 18 powerful ways to supercharge your borrowing capacity, 19 critical questions you ask a mortgage broker, DSR ratios, how to structure your property portfolio to replace your income, mortgage reduction programs, the whole works. It's free. It's my gift to you. And also goes through hotspots in Melbourne, which haven't really changed in the last few years as well. So it's 10 hours of video plus a 265-page manual, instant access, no upsell. You don't need to buy anything. It's absolutely free. Scroll down below and access it immediately. And there's no strings attached. You don't need to do anything. No one's going to call you and book you in for anything you don't want to be booked in for. It's just there for you purely to educate yourself about property investing. For those of you who want to work with me, and I run a company called Investors Prime Real Estate, where I source properties in Melbourne's highest capital growth suburbs. If you want to get a 60-minute free strategy session, I'm getting booked out quite heavily now. I'm kind of booked out for the next 2.5 weeks from last year, but I will have spots available. Feel free to just contact me directly via email, and I can book in a 60-minute strategy session, work out where you are, where you want to be, and develop a bit of a plan. Remember, if you fail to plan, you plan to fail. So a lot of people waste so much time and energy focusing on the wrong things, looking at the wrong properties, wrong structures. I can fast track all that for you, make it simple, and you can get from A to B, which is really what we're doing, is getting from A to B, which is A, where you are now, B is where you want to be in the future, income-wise, lifestyle, holidays, all those kind of things, and property is a vehicle to get you there. So it's an hour strategy session, free, there's no cost, plus you get an introduction to my mortgage broker, accountant. I'll give you my whole team if you want. You don't need to if you've got your own team, but if you want my team, I can share those details with you. So Cameron Fisher is one of them, Stephen McClutchy, Director of Loans Australia, James Black from Brand Nico Accounting. You work away with a real strategy, paint by the numbers system, and I'll show you how to get started. It's really good for people that have never started to invest, and you're getting your first property. There are qualifications. You need to be at least pre-approved or have the ability to buy a $700,000 property. I don't source anything under $700,000, $695. So if you're a single borrower, you need to be at least on $95,000 income and have at least $112,000 in cash or equity available in your property or your parents' property. Otherwise, you can't buy a $700,000 property. If you're a couple, you need to be kind of on $60,000 and $80,000 combined and have $112,000 in available cash savings equity. If you do, you can qualify. You can buy a 2-bedroom townhouse in a good suburb and get started and get your foot in the door and get into the property market. All you got to do is email me directly, conrad@investorsprime.com.au. There's a bit of a wait at the moment because I am booked out from last year. A lot of people have requested these consultations. So I'm just back from holidays now and I'm seeing all the people. But be patient. I'll definitely get to you. Just send me an email directly and I'll reply. We can book a time that's mutually convenient. That's it, guys. That's it from me. Thank you very much for tuning in, and I hope to see you live at the event in Melbourne at the end of, or the 1st or 2nd of February, I think is my first one, or on Zoom. This is Konrad Bobilak, guys. See you on the inside.